Hello friends, welcome to Sachdeva classes, and in this session we are going to discuss compulsorily convertible preference shares, that is CCPS. Now what are these CCPS? As the name suggests, these are a kind of a preference shares, and as a preference shares these have a priority right over the equity shareholders with respect to number one, dividend distribution. That is, if the company has to pay dividend to its equity shareholders, it will have to first pay the dividend to its preference shareholders, then only it can pay dividend to its equity shareholders. Number two, repayment of capital, initial capital. That is, if the company wants to repay its equity shares, it will have to repay first to the preference shares and then it can repay the amount of principal to the equity shareholders. So preference shares have a priority right over equity shares with respect to dividend distribution and repayment of initial capital. CCPS has a mandatory conversion feature. That is, these CCPS will get converted into the equity shares of the issuing company upon occurrence of a certain events or at a predefined date. Let's say, as per the terms of the contract, the CCPS will get converted into equity shares at the end of 5 years. So at the end of fifth year, these preference shares CCPS will get converted into the equity shares of the issuing company. CCPS may or may not have the voting rights. It will depends on the terms of the contracts, and the terms of the contracts will define whether CCPS have the voting rights or not. The price at which these CCPS will get converted into equity shares is called the conversion price. So friends, having understood what exactly are CCPS, we will now see whether these compulsorily convertible preference shares are equity instruments or a financial liability as per Ind AS. So friends, whether these CCPS are a financial liability or an equity instrument, we will try to understand this with the help of an example. In this example, RAM Limited has issued non-cumulative 4% per annum CCPS to Sham Limited for a consideration of 50 lakh rupees. RAM Limited is the issuer and Sham Limited is the holder. These preference shares are converted into a fixed number of equity instrument in the ratio of 1:1 any time up to a period of 5 years. The payment of dividend is as per the discretion of the issuer, that is RAM Limited. Friends, whether these are CCPs are an equity instrument or a financial liabilities, we will try to understand this with the help of a flow chart. Ind AS 32 defines what are financial instruments. Ind AS 32 defines what are financial assets, what are financial liabilities, and what are equity instruments. So as per the definition of equity instruments, there are two conditions which need to be satisfied. First, it is not a financial liability. What is a financial liability? Ind AS 32 says either there is an obligation to pay cash or there is an obligation to transfer financial assets under potentially unfavorable conditions. So if there is no obligation to pay cash, if there is no obligation to exchange fixed assets, financial assets under potentially unfavorable condition, then it will be termed as equity instrument. The second condition is entity has to issue its own shares. Now we will see whether the issue of these shares results in a fixed number of shares or a variable number of shares. If there are variable number of shares that has been issued, it is a liability. If the fixed to fixed criteria is passed, that is fixed number of shares are issued, then it is an equity instrument. So friends, in this case, applying the definition of equity under Ind AS 32, firstly, there is no contractual obligation to pay cash or any financial assets. The dividend payments is as per the discretion of the issuer. The issuer can and issuer cannot pay dividends, may or may not pay dividends. It is entirely up to the discretion of the issuer. Hence, there is no contractual obligation over the issuer to pay dividends. Secondly, these preference shares are converted into a fixed number of equity shares, that is fixed to fixed criteria is passed. Hence, it meets the definition of an equity instrument. Friends, let's take another example. In this example, RAM Limited has issued CCPS at rupees 100 each for rupees 10 lakhs. That is, there are 10,000 number of CCPS. These are convertible into equity shares at the end of 10 years, where the number of equity shares to be issued shall be determined based on the fair value of the equity shares at the time of conversion. So friends, again, we will evaluate this with the help of this flowchart. Is there any obligation to pay cash or exchange financial assets under potentially unfavorable conditions? The answer is no. That is, it is not a financial liability. So the first condition is met. Whether own shares are issued? Yes. Whether the number of shares issued are fixed number of shares or a variable number of shares. So it says these are convertible into equity shares at the end of 10 years, where the number of shares to be issued shall be based on the fair value of the equity shares at the time of conversion. So let's say at the time of conversion, the value is 15 lakh rupees, that is 15,000 shares will be issued. Or let us assume that the value will be 20 lakhs at the time of conversion, so 20,000 shares will be issued. So here in this case, the fixed number of shares are not issued. Variable number of shares are issued, that is 15,000 or 20,000. It can be less or more as the case may be, depending on the fair value of the equity shares at the time of conversion. So since the conversion is into a variable number of shares, that is, it fails the fixed to fixed test, it meets the definition of a financial liability. So friends, whether CCPS are a financial liability or an equity instrument, it will all depends on the terms of the contract. If the fixed number of shares are issued, that is fixed to fixed criteria is passed, then it will be classified as an equity instrument. If variable number of shares are issued, it will be classified as a financial liability. So friends, I hope the classification between equity and liability is clear, and the concept of CCPS, compulsorily convertible preference shares, is also clear. That's all for this session. Stay tuned for more such updates.